What separates an average investor from a legendary one? What separates those returns that barely even make it worthwhile to the extraordinary ones that help build a lifestyle, a legacy lifestyle, something that you're proud of? I firmly believe it's mindset. I absolutely mean this sincerely. It may sound simple, it may sound overlooked, it may sound like, yeah, whatever, but you can do all the research you want on a stock, on an industry. You can spend all the time researching the management and everything else. When push comes to shove, when emotions get high, when you allow yourself to be influenced by something, whether it's the economy, whether it's CNBC or Bloomberg, whether it's, a stock tip that you overheard at the gym or somebody that you respect who's doing something. If you don't have a strong mindset, if you don't have an investor's mindset, you're going to be easily taken off course, easily distracted by somebody else's journey or white noise that has no value to you whatsoever. Building that investor's mindset is absolutely what's so critical to your long-term success. And you might be asking, well, how do I do that? So I've got a few tips for you. Now, this is applicable whether you're a seasoned investor or whether you're just starting out. In fact, if you're a seasoned investor, my guess is either you have a hardened mindset, maybe you're just looking for some more tips and strategies, or you're getting beaten up. You're tired of the losses, you're tired of the stress, you're tired of it, and you're really just wondering if you can keep doing this. What I want everybody to understand is that investing is a game best served without emotions. Now, it's easy to get emotional when you find a deal, right? Imagine if you knew what Apple was going to grow into 30 years ago, hell, 20 years ago, right? Imagine that. If you could see forward and you're like, oh my God, I'm going to remortgage my house. I'm going to sell my everything. I'm going to sell my children's college tuition. I'm going to liquidate everything and I'm going to dump it in Apple. Well, we don't have the luxury of knowing that. But what I can tell you is, would you have held on through all the peaks and valleys? Because it's easy to look back now and say, oh wow, that was easy to predict, easy to understand. It's a lot harder to see that at the beginning. And the mindset is what keeps people separated. The mindset of an investor is somebody who is kind of like a fighter. They're really good at getting punched in the face again and again and again, and they don't take their eye off the prize. They know where they're going, they know their destination, they know there's going to be some bumps along the way. That investor mindset starts by creating rules. You see, if you don't have rules for your investments, then what you're really doing is gambling. Because if you were to track all your investment decisions without rules, I'm willing to bet that a lot of them were done or executed or changed based on emotions, based on feelings, based on gut, based on greed, based on fear. How many times have you bought something, bought a company, bought a stock? Maybe you haven't yet, but that's okay. You'll still see this in your own investment career to come. And you were right, your thesis was correct, and you bought it. And it went from $10 to $20 in the next 6 months. You doubled your money. And you're like, holy crap, wow. Well, do you sell? Do you hold on? Do you buy more? Whatever your systems are will guide that. And if you don't have systems, this is where people start to make poor decisions. They start to get greedy. Maybe they do have a system that says, once I make 50%, once my investment goes up by 50%, I take it off the table. Whether that's 6 months or 6 years, it's done. I sell it, I reallocate that cash to something that's underpriced, and I move on. But too many people, when it comes time to do that, they go, well, just this one time. Just this one time, I got a feeling. I've got a feeling about something. You might have a feeling. But it's best to book your profits, it's best to stick to your rules, whatever they are, and live to fight another day. Because inevitably, if you go against your rules, and you're rewarded for that, this is the worst part. Imagine if you start small. You have a $20,000, $50,000, $50,000 portfolio. And you don't listen to any of your rules about allocation size, profit taking, entry points, and you put it all in a stock. And then that stock doubles. Well, all of a sudden, you've been rewarded for the wrong actions. And now you start to build habit based on a shaky foundation, based on poor skill set. Skill set that's going to get you in trouble later on. Maybe that $50,000 loss wouldn't have crippled you. But now that you just made $50,000 and you think you're the smartest person in the world and you knew something that nobody else knew and you can beat the market every single day, well, what do? Do you get greedy? Do you pull out a line of credit? Do you draw on a credit card? Do you sell your home? Do you take savings out? Do you take emergency funds out? Just this one time, I got a feeling about it. Rules keep you in check. Rules make sure that your wealth is predictable. We don't know what's going to happen in the market tomorrow. I mean, clearly these times right now with the coronavirus just proves that. If you would have asked me in the middle of February, when the coronavirus was just very, very quiet and just, something happening in Asia, overseas, nothing to do with us, not even really disrupting any industries back, early February, I would have said the stock market's going to keep rallying. When you look at all the momentum behind and you look at unemployment in the US and you look at earnings and you look at all the things and all the tailwinds pushing the market, I would have said, I see something happening based on 100 years of history, based on the fact that recessions happen every 7 to 11 years. There's going to be a correction at some point, but I would have said, if I had to bet, if I had to gamble, I would have said it's more likely than not that the stock market will continue to go. And if it doesn't rise, I'd be pretty skeptical that it would fall far. But now here we are. So keep your systems in check. Create rules for yourself. Create diversification rules if you're somebody who doesn't have a high risk tolerance. If you know that, watching your account get drawn down really causes you a lot of stress, then maybe you do want to diversify more than somebody else. Over diversification may help you sleep at night, but it also limits your gains. It limits your upside. And if you're over diversifying to the point where you've got so many positions to manage, I'm not going to give recommendations or advice, but talk to a financial advisor and they're probably going to tell you you're best to just stick it in an index fund. That way you don't have to think about it. You don't have to manage all these different positions. If you're somebody who's more research-based, don't mind putting in the time. You really love to research. You want to get in there, know the nitty-gritty. Then maybe you focus your approach. Maybe you spend more time knowing the ins and outs of a few companies versus a general consensus about the entire market. Maybe your diversification looks much different. You've only got a handful of companies and you're okay having a large percentage in each one of them because you know them so well. It's no different than if you owned the company. And you're okay if it goes down 25%. Doesn't bother you. You've got a higher risk tolerance. You've got a long time horizon. Who knows what it is? But whatever it is, make sure you have rules. Exit strategy rules, order entry rules, dollar cost averaging or tranching rules. Break your money into chunks. Each chunk is called a tranche. Or maybe every month you just put $500 away every single month, you dollar cost average. So keep that system, keep that rule. Whatever it is, make sure you have rules. I advise that you write them out. Keep them right by your desk. Post them on the wall beside you. Do a checklist every time that you're about to execute a trade. Go through this checklist. Is there an earnings call coming up in the next couple days, couple weeks, couple months, whatever it is that's based on your trade? Do I love this company? Do I understand this company? Do I need this money? Right? Don't ever invest anything that you can't do without, because that's not investing, that's gambling. Make sure that you understand that your account could go to zero tomorrow and it wouldn't, drastically change the quality of your life. If you're somebody who's retired or semi-retired or considering retirement and you're a dividend investor and you rely on that dividend every single month, well, now is probably not the time to be taking a lot of risks because maybe you don't have as much time to get back on track if something doesn't go the way that you plan. Have these rules. Focus on it. Practice. And if you're unsure, if you're really skeptical, then I absolutely recommend everybody opens up a paper money account. You can download a discount brokerage account. You can download one through TD Ameritrade, Thinkorswim. You can download through Charles Schwab. You can download through Interactive Brokers. The Chicago Board of Options Exchange has one. I'm sure there's a million other platforms that offer these. A paper money account tracks the real market. It's like you're in the real market, but it's all fake money. You start off usually with $100,000 and you can practice. So practice, go through the mechanisms, buy that stock that you like. Go back in time, research what happened to that stock. How did it perform in the last recession? Have they raised their dividends or not consistently, if that's something that's important to you? Go pull up their investor relations website. Go back and look. What kind of things are going to cause them to change what they've been doing? Whatever it is, make sure you have systems, rules in place that allow you to sleep at night. And your long-term success is almost guaranteed. You just have to stick to it. Don't bend the rules, don't pretend you're smarter than the rules, and make sure you create rules based on fact. Don't create rules based on feeling. You know, oh, that sounds good. No. If you have a feeling about something, then go and back check it. Go and back test it. Go and confirm it, research it. Does it work? Find the empirical evidence to confirm your suspicions. Then create a rule around it. And die by these rules. Use them religiously. That way, it takes a lot of the emotions out of it. Because as much as I like to say I'm a robot and I never get emotional, it's crap. I'm human. You don't think I get excited when I buy something and it goes up in price? You don't think I get a little upset when I buy something and it goes down in price? I'm human. I have systems. And I can go back and look at every single time I've taken a loss. Most of those times, it's because I broke my own rules. I lied to myself. It sounded good. Oh, there's so much momentum. The market can't turn around. Oh, the probabilities. No. I have rules. I broke a rule. I lost money. Almost every single time, it's because I didn't listen to my rules. So this is a life journey. You're going to be fighting with yourself constantly. And the better you are at following your systems, the better you are at, getting punched in the face, as I said, a strong investor mindset will absolutely outweigh all the luck, all the potential stuff, all the feelings, all the bets that you didn't take. And if it really helps satisfy that, that gambler inside of you, if it really helps calm it down, then take a percentage of your portfolio. Again, we'll say you have $50,000. And maybe you decide, you know what, I'm okay losing 5%. If I lost 5% tomorrow, it wouldn't even bother me. So maybe you take $2,500 and that's your gambling portfolio. That's what you try and experiment with things, right? That's the money you use for that gut feeling. I think Tesla's going to blow up this month. It's going to go, man. It's okay. You go buy some shares of Tesla based on that gut feeling. And you allow it to play out the way that you hope it will, the way that you think it will. And if it goes wrong, you're okay. You've made peace with that 5%. If you lose it all, you're fine. Because remember that hope is not an investment strategy. It is absolutely not. Pray for sunshine, hope for sunny days, but do not hope for success. Do not hope for wealth.